Good afternoon and welcome to both members and guests joining us both online and here in person. It's my understanding that there's probably more than 65 of us here, either in person or online. That's a great attendance. For those of you who don't know me, I'm Judy Bonavac, and it's been my pleasure to serve as the chair of the Professional Advisors Council of the Community Foundation of Broward. We appreciate you taking your time out of your busy schedule to attend our program this afternoon, a program we believe will be beneficial to all of us in our individual practices. For those of you who are not aware, membership in the Professional Advisors Council, that we also call PAC, is exclusive to professional advisors who have introduced their clients to the Community Foundation, which introductions have resulted in a client either creating a fund currently or through their estate plan. In addition, professional advisors will be invited to become a member of PAC if they create their own fund with the Community Foundation, either currently or again through their estate plan. For those of you who are not already a member of PAC, please be aware that as a member, you will not only have helped your client realize their philanthropic goals, but you will also be included in extremely valuable educational and networking opportunities, such as this program today, where we learn more about tax, legal, and financial issues, as well as how to connect with people who care with causes that matter. The PAC meets 3 times a year, and its members are also invited to all donor gatherings. Please join me in recognizing the Community Foundation's current board chair, Kurt Zimmerman. Kurt, where are you? Board chair is Bill Snyder. Katz, who I believe is online with us. Yes. And past board member Jim Davis, who's one of our panelists today. Have I missed anyone? All of these individuals have contributed countless hours to the foundation, and I would like to personally thank them for all of their contributions. This is our last PAC member or our PAC meeting of the season and my last as chair of the PAC. I would like to take this opportunity to announce that Greg Medelli, who has been a long-standing member of PAC and is also a Community Foundation Legacy Society member, will be succeeding me as incoming PAC chair. As PAC chair, Greg will also have a seat on the board of the foundation. Please join me in congratulating Greg. I would also like to recognize the philanthropic services team, Nancy Thies, Mark Kotler, Jenny Powers, Andrea Baker, and the rest of the foundation staff who are here to serve and your client, to serve both you and your client's needs. Would you all please wave, stand so everyone knows who you are? I also want to take this special opportunity to welcome the newest member of the team, Mary Margaret Toole, who is coming to the foundation with 5 years of experience as a financial advisor and will be assisting in expanding outreach and engagement of professional advisors with the foundation. Mary Margaret, will you please stand so that everyone who has not had the opportunity to meet you. Now, let me turn the program over to Jennifer O'Flannery Anderson, the president and CEO of the foundation. Jennifer.
Judy, these are for you, for your service to our organization and to the PAC and to the board. We can't thank you enough, and we couldn't think of anything better than beautiful flowers.
Well,
So thank you. Thank you very much. All right, good afternoon, everybody. Thank you so much for being here, and all my friends on Zoom, thank you. I also wanted to recognize David Scully, who's on Zoom. He's one of our board members, and you'll always see about 1/3 of his face on the Zoom screen. So when we go back, you'll see him. But anyway, Thank you all on Zoom and here in person. I'm going to attempt in about 10 minutes to give you a quick update on where we are at the Community Foundation. We last week had all of our former board members here for breakfast. So unfortunately, Jim Davis and Bill get to hear this for the second time, but they're good sports and they'll correct me when I make mistakes. So that's really good. But I'll give you a little update and I'll keep this to 10 minutes. So maybe you'll give me a 5-minute and a 1-minute signal. Okay, so you guys all know that professional advisors have been an integral part of the Community Foundation. Our first board chair was Jim Glosser, who is an estate planning attorney, retired now. We've had many amazing gifts that have come through estates. The first one was from Harold Franks. That really helped put us on the map. And now we've been in the 2024, we'll celebrate our 40th anniversary. Next slide. I'm sorry, Ashley, I can't see you. Okay, this is just a quick glance at our organization. We have almost 500 funds. 200 of them are held by living donors and 300 are from donors who have passed. Over the past 37 years, we've granted out almost $150 million. And just last year, we granted out 14 million. One of the things we're really proud of is that we have over $360 million promised to the foundation in current estate plans, and most of those are all through people like you, through our professional advisors. And another point of pride is that there's about 700 community foundations in the nation. We go through a process of getting accredited, and then we get ranked on total assets. We were the first community foundation in Florida to go through that process and to be ranked. And now, little by little, we've gone from 100 to 94 to 90. Last year we were 89, and now we're 83. So we're notching up or down in a good way. So anyway, Ashley, next slide. What I'm going to share with you quickly is a little summary of some of the points in our strategic plan. We went through a process from March to October of 2021 with our board and with our staff to really revisit the strategic plans that have been in place and to kind of figure out what's the next phase for this community foundation. Several of you were kind enough to participate in our focus groups that we have. We involve fund holders, professional advisors, board members, staff, community leaders, and nonprofits. And we got some extraordinary feedback, which I could talk about for days, and I won't. But from that really helped form our pillars and our grant-making focus, our issues that matter. So actually, next slide. This really just gives you a summary of our vision and mission. We updated and refreshen these a little, but we try to keep some of the elements that I feel are things that we connect with this community foundation. My favorite phrase being that we connect people who care with causes that matter. And we also, in our mission statement, you'll see we are committed to building endowments. So that's something that we really focus on as a community foundation. It's one of our differentiating factors, and we try to share that with the rest of the community. Ashley, next slide. So this is great. This tells you our values: lead with purpose, cherish diversity, create collaboration, empower philanthropy, and listen, learn, and share. So these are the values that gird our organization, will really drive our work. And I hope that they make you smile like they make me swell with pride. I feel like I can wake up and think about these values and live with them each day. Next slide, Ashley. So the next important thing are our goals. We call them pillars. And there's 6 of them. We want to make sure that we are providing great community leadership. We provide and continue to evolve and enrich a donor experience for our fund holders, for your clients. We want to strengthen Broward's endowment. How do we change this community and be there for the future? And that's by having a strong endowment. And so that is something we're really committed to. We want to grow our assets by about $110 million over the next 5 years. We want to make sure and continue that our grant making is impactful and changes lives and improves our community. We want to make sure that we share the value of the Community Foundation. What is it that we do and how is it important to this community? And finally, we always want to make sure that we have really strong operations, great stewards of the investments that we are taking care of, and that we're thinking of ways to improve and improve this community. Next slide. So our issues that matter are we've condensed from 10 to 6, and they are education, youth empowerment, social and economic mobility, healthy, thriving families, art, and culture. I would say those are kind of our 4 big ones. And then the 2 at the bottom, racial equity, diversity, and inclusion, and creating an excellent world for our nonprofits are 2 that kind of infuse the other 4. In everything that we do, we want to make sure that we're focused on racial equity, diversity, and inclusion. And we always want to make sure that we are lifting up nonprofits, we're improving the profession, and we're making them be more efficient, helping them work better together, and being able to deliver better services to our citizens. Next slide. This is my favorite one, especially for accountants. Any accountants in the room? All right, okay. So this has been tested by Keith Cobb. If anybody knows Keith, I ran this by him several times, and it has his stamp of approval. So what this shows you is our asset growth. The blue line is the current is real-time asset growth. So 1984, our first gift, $8 million in the endowment. It's grown over the next 37 years to almost 300 million. So what's great about this is you can start to see the curve pitch higher and the acceleration really happen. So what we did is we projected the next 5 years. In 2026, we should be close to $400 million in assets. And if you kind of look at the bottom, if you could read it, it would tell you how many staff we project to have, how much we have in assets, what we think we'll be granting out. So by 2026, we should be granting out almost $20 million a year. Right now, we're granting between 13 and 14 million. And our operational budget will go from about 3.5 million last year to about 5.7 million. And what we're doing is we have assumptions to hold for growth and conservative measures, but this helps us see in 10 years, we'll be over 500 million, and our organization will have over 36 people, and we'll be granting out over $25 million. So for me, this is really exciting to see that curve up, and then to get an idea of what our organization will look like and be able to think about the impact that it'll have. Actually, next slide. And next slide again, because this just shows, this is really, that was the growth of the grant making. This slide is nice because for all of you, it shows our investment returns. In 5 years, we had 11.6% investment return against our benchmark of about 10.7. 7-year was 7.6 against a benchmark of 7.1, and 10-year is 7.8 against a benchmark of 7.2. So we have an amazing investment committee led by our board and other business leaders in the community. We work with crucial partners to make sure that we are engaging some interesting projects and investment opportunities. And so we're really proud of that. And finally, our community builders. These are folks who have given $1 million or more in endowment to the organization. Next slide, Ashley. We have 49 community builders. I need one more for 50, one more. 22 of those are living. So that's pretty amazing. And most of those have come in the last 5 or 10 years. So we've had this really wonderful shift where our donors are living, engaged in the organization, and then thinking about how the Community Foundation can be part of their estate plans, not just coming to us as they're doing their estate plan. So it's nice to have both. And the thing that we're most proud of is that 80% of our community builders come from a professional advisor, from all of you. So I can't reinforce enough how important you are to this organization. And if you think about that curve and our asset growth, and that is all coming because of you being partners with us and allowing us to work with you and to learn how we can be best in service to you. So finally, last slide, or almost last slide, plan giving. I mentioned we have $360 million planned to us in about 165 different estates, and they're absolutely amazing people. We just got together with them a couple weeks ago, and this is really a big point of pride for us. We can project and know over the next 10, 20, 30, or 40 years, how much is coming in from estate gifts. Okay, final slide. So we are doing our Be Bold campaign. We hope to raise about $500 million by 2024. And right now we are exactly halfway through that point. So I'm really proud of these accomplishments. And again, it's really helping our organization shift to be forward focused, being partnered with you, and to be serving our donors while they're living. And then we're better able to reflect their wishes when they're gone. So I'm going to finish my comments by putting the last slide up with initiatives. This gives you an idea of some of the projects that we're working on right now. We've just finished an environmental sustainability and education grant. We are doing a lot with the aging population. This morning I was on a call for 2 hours doing our cancer grants. We have just initiated a small grants program for small nonprofits serving Black and Brown communities. Operating budgets under $500,000 can apply for really simple one-page application for operating dollars up to $25,000 a year. So we're very excited about that. And we really appreciate the opportunity to work with each of you. And Mark and Margaret, we're happy for them to be at your service. Nancy, Jenny is on Zoom, and then Andrea. So Bill, I'm going to wrap it up here and turn it over to you. Thank you for your many, many years of leadership and service to this organization. And thank you all for your time and attention.
Thank you, Jennifer, for the great job you're doing here. We really appreciate all of your hard work, and thanks so much. This panel has done this now. I know we did it all, the same panelists last year, and somebody must have made a mistake having us back again. But we did all get invited back again, and we appreciate that, and welcome to everyone. Let me talk a little bit about our panelists. To my right is Jim Davis. I'm sure all of you know Jim. He's a shareholder at the Gunster firm. He's co-chair of the firm's tax practice group, serves as general counsel for ERISA. His more than 40 years of experience in law includes ERISA and employee benefits law. When we as a panel met to try to figure out what was the best of Heckerling, I think by unanimous vote, we felt like the post-secure 401(a)(9 proposed regulations were really the biggest thing that happened at Heckerling this year. And so we've allocated to Jim the most time today to talk about the new proposed regulations, which are, to me, very surprising. These regulations have changed a lot. They're surprising. So we're going to spend most of our time today, the majority of our time, talking about those regs. In addition, as another panelist coming back this year is Nella Collado. She is senior advisor and co-owner of Tobias Financial Advisors. It's interesting that prior to joining Tobias, she was a principal at Bessemer Trust in Miami. She serves as a member of the Florida Institute of CPA's Women's Leadership Committee. And it's a pleasure having Nella back with us. And lastly, down on the end is Dr. Adam Goldberg. Adam is a graduate of Nova Southeastern University Law School, has an LLM degree from University of Miami. He teaches currently in the LLM program with myself and Jim. All three of us teach in that LLM program. And he's lectures a lot, and he's going to be sharing some material today on donor advised fund proposed changes, the Biden tax proposals, some interesting material on community property and trust modifications. Nella is going to be talking about what we thought were two of the most important cases, the Nelson case and the Small Dino case, and also sharing some information on gifts to grants. So with that, we're going to talk about donor advised fund proposed changes, and Adam's going to lead off on that.
Thank you, Bill. I'll see if I can get uninvited for next year. So as you know, Heckerling was not its normal January slot, and it was not in person. It was online again. It was in March. So that gave a lot of the speakers a lot of time to give comments on stuff that happened since the new year. What we tried to do in this part of the presentation is give you some of the highlights from really Monday's afternoon session, which is where you get a lot of opinions and a lot of thoughts on what's coming down the pipeline. There was a significant amount of time spent talking about donor advised funds. I don't think I have to find them for this group. I do want to let you know that according to the IRS and the National Philanthropic Trust, there's approximately, thank you, a little over 1 million donor advised funds in this country, holding assets of $160 billion. In the year that we have the most recent information, which was 2019, over $38.8 billion was paid from donor advised funds. Average donor advised fund has about $160,000 in it, and it pays about 20% of its holdings annually. So just some basic stuff. What we're really talking about here is the Accelerating Charitable Efforts Act, brought to you by Senator King, who caucuses with the Democrats from Maine, and Senator Grassley from Iowa. The reason I bring that up is because we've got Republican and Democrat on board, there is some chance that this may pass, or some versions of these things may pass. So I don't feel like we're wasting your time on this. What they're talking about doing is creating different types of donor advised funds, a qualified donor advised fund and a non-qualified donor advised fund. What they're looking to do is kind of rope these in a bit. It almost seems too good to be true. With a qualified donor advised fund now, you will only have 15 years to distribute the assets in the donor advised fund. Failure to distribute within that 15 years would subject it to a 50% penalty on undistributed funds. So that's an interesting note. In addition, the person who donates something to a donor advised fund will not get the income tax deduction until the asset is basically turned into cash. So if you donate tangible personal property, artwork, if you donate a business interest, you will not be able to take the deduction, your charitable deduction, until the year that the donor advised fund turns that into cash or marketable securities. So that's certainly something very interesting. That would be a very big change from what we're used to. The non-qualified donor advised funds would have a 50-year life expectancy. Same rule as before, you would not be able to get the deduction until you turn the assets into cash or cash equivalent. But the one interesting thing here, also here is you would be required, much like a private foundation, to donate 5% out of the donor advised fund every single year. Since we're sitting here in the Community Foundation, I thought I would just also throw out that any qualified Community Foundation donor advised funds would also be subject to that new 5% annual distribution. So those are some very significant changes. I can't tell you whether or not any of them are going to pass, but because you have Republicans and Democrats on board, it's likely that some of those things will pass. What I wanted to talk about next was the Biden tax proposals. It was the absolute first thing that the panel talked about on Monday afternoon. These were part of Biden's 2023 and his team's budget. One thing, of course, was to raise the marginal tax bracket for top income tax earners. They basically want to bring back the 39.6% bracket for those people earning $400,000 or more, and they'd like to raise the corporate tax rate back up to 28% from the current 21%. The biggest part that they talked about here was the new minimum tax on the ultra rich, which is for people worth $100 million or more. This is going to be a tax on unrealized gains. I thought the easiest way to describe it would just be to give you an example. So back in 2007, Jeff Bezos paid no federal income tax. Hopefully all of you know him, Amazon founder. So he paid no income tax in 2007. That same year in 2007, Amazon's stock doubled, more than doubled, but he still paid no tax. If this tax had been on the books, he would have had to pay 20% on the increase in the stock value. So this isn't a true wealth tax. I will tell you that Manchin, since I was preparing this presentation, Senator Manchin has already said he's not real excited about that. However, I've also told you that Bernie Sanders and Elizabeth Warren, two senators, also said that they would be on board with something like that. It's likely to be past constitutional muster because it's not a direct tax on wealth. If you're into politics, you understand what I'm saying there. This could raise $360 billion over a decade. The last thing about the Biden proposal that I think is important to note is significant increase in funding of IRS. That would include in technology. The Biden administration feels that a lot of things are getting through the cracks because very few organizations and individuals are being subject to audit. So those are two things. Again, all of those are speculative. But those are two topics that were very big during Heckerling, especially in the first afternoon. Thank you, Bill.
Thank you. Okay, next, Nella is going to talk to us about the Nelson case.
Yeah, I'll walk you through some interesting nuances involving formula clauses. And this involves the Nelson case. This was a Fifth Circuit decision affirming a 2020 tax court decision. And basically, the story goes like this. Ms. Nelson owned a 94% interest in a limited partnership that owned a 27% minority interest in an operating business. What they did is, with the help of their professional team, they executed two transfer documents. One giving sufficient interest in a holding company that had a value of $2 million. And the second was selling a sufficient interest in the business in the LP that had a value of $20 million. So they did get a qualified appraisal, and the gift of 6%. There was a gift of 6%, and the sale was determined to be 58% of the LP interest. So the IRS, of course, looks at this and looks at the formula clause, which was based on the value that they determined that interest to be. And the IRS didn't agree. And what they determined is that the Nelsons own gift tax of $6 million, okay? So what they tried doing was applying a formula clause, which we all try to put when we're making gifts of an interest that requires a valuation. We try to put a formula clause that says, you know, the value is going to be based on the amount finally determined for gift tax purposes. In this case, they tried doing a formula clause, but instead just put the value of $2 million, didn't actually specify that it was based as finally determined for gift tax purposes. So basically, the IRS didn't agree and tried to attach a $6 million gift tax bill to that gift. They lost not only because the formula clause didn't work the way they had phrased it, but they used the wrong formula. So really, the learning key here, the learning point for all of us is to make sure that if you're using formula clauses, that you're pointing to the right formula language, because this can backfire. So the Nelson case was bad for the Nelsons, but I think it was good for all of us as planners, because what we learned is that they did approve the use of formula clauses, which makes us all very happy. But that indicates that the value is, that it has to indicate that the value is based on the amount finally determined for gift tax purposes. So that was something of interest to all of us. They talked a little bit about gifts to grats that I wanted to talk about as well. And I think I was in grat world last year with interest rates the way they were. We were just taking advantage of really low interest rates to set up grats in anticipation for a potential drop in the estate tax exemption in 2026. So they had an example here where bad things happen if we don't follow the rules associated with grats. So in the example, the grantor got a little bit too aggressive with the valuation that they use for the transfer to the grat. So just to back up a little bit, and maybe you all know this, but with a grat, you agree to put X dollars into a trust. and you tell IRS, listen, I put X dollars, but I'm gonna take X plus one. That plus one being the 75/20 rate as determined and published by IRS. If the assets grow by X plus 10, that difference stays inside. That's a successful grant, and it goes to next gen, hopefully, usually an IDGIT, intentionally defective grantor trust. In CCA 2215-218, what happened is that the CEO of this company tried getting very fancy. And interestingly enough, last year, Kaylee and I from Bill's firm were working on a situation that almost sounds exactly like this. And Kaylee, of course, said, this is not happening, not on my watch. We're not going to let the CEO do this. So the CEO uses an appraisal to determine the fair market value of the shares that he transferred to the grant. This appraisal he had was an internal, it was prepared for a specific purpose. It's called a 409A valuation, which is used internally for the company. So the CEO knew that at the very same time that he was creating this grant, that the company was in the process of being sold. So the little important fact that we need to know as planners, because that changes the whole strategy. So roughly 6 months after the grant was created, surprise, the company was sold for 3 times the value that was initially used for the grant funding. So you would expect that the IRS would say, I'm sorry, you're gonna have to adjust the annuity payments back to yourself because the value is higher. Well, fun fact is that's not what they did. They basically said, we're not going to allow that. We're going to treat the whole thing as a gift up front, which is a pretty bad outcome. And the reason why they did this, and they cited Atkinson, if you will remember, that was a case where the CRT was not administered correctly. So basically, the court agreed that since the intent was that there was no intent to operate the GRAT the way it was intended to be operated, the way it should have been operated, the grantor never intended to create a real GRAT and never intended to take back a real annuity payment. So they treated the whole gift as a gift up front, subject to tax. So the solution here, as was recommended, is that perhaps in this case, he could have been saved if they had a longer GRAT, because what happened is that by the time the IRS challenged the GRAT had matured or basically completed its term. So the solution here is that maybe if you're getting fancy with valuation, first of all, if you know there's a sale, you shouldn't be entering into a transaction like this if there's a pending sale and that value of the proposed sale. If you already, I tell my clients, you have a letter of intent before we go down this path, because they already know something is percolating. But really the solution here is that perhaps if he had had a longer GRAT, he could have had given the IRS room to just adjust the annuity payments. But in this case, the GRAT had already reached its term. Anyway, I love GRATs, but to move on, I want to touch a little bit on the Smaldino case, because this was also a situation that Kaylee and I were dealing with last year with a client trying to use his special 409A valuation to create a family partnership and then gift minority interest. So in the Smaldino case, the IRS makes the case that assets given to a spouse just to make a gift to the trust was really assets that the husband put in. So they didn't allow enough time for the first transaction to marinate. So, and we have to be careful because perhaps we're all guilty of this. So we recommend husband, all these assets are in your name, give them to wife. She's gonna then create a trust for your benefit. So in the Smaldino case, basically, there wasn't sufficient time allowed between one transaction and the other. And in effect, the husband was treated as having made the gift, could have been treated as having made the gift to himself. And as you all know, that creates a 2036 problem, which means that the whole value of the trust would be includable in his estate because he made a gift to himself. So other facts in the Smaldino case, and this is not something that none of us would do here, Basically, they didn't even have dated documents. You know, when they went back to look, documents weren't signed, they weren't dated. The documents that they did have in place basically alluded to that, you know, they would be effective as of X date. Again, not having properly taken the steps to create the entities, have them marinate, then make the contributions, then get the valuation. It was like everything was just created and then they said, well, effective as of April 14th, you know, this gift was made and the assets were transferred the next day. They already knew the value. Again, just real messy fact pattern. So no gift tax were even filed to memorialize the gift. That's a big one. Every time a client tells me, well, I have this irrevocable trust, immediately my next question is, great, do you have the gift tax return where you're showing the transfer of those assets into the irrevocable trust? And then they look at me like I have 10 heads because no one ever mentioned the gift tax return. And so, you know, we don't really think about it, but it's when the IRS is questioning it, now we're trying to put all our ducks in a row. So the other issue here in the Smaldino case was that in the document, we had arranged for a series of guaranteed payments, which were going to be treated as management fees. And then they used that clause to reduce the value of the gift. So they said, well, because he has this guaranteed payment due back to him, that's going to reduce the value of his gift. And then surprised immediately after, then he just terminated the guaranteed payment agreements. So the IRS was not too happy with the fact pattern. So again, that just kind of shows that we need to make sure that we dot our I's and cross our T's in the planning.
Yes, Nella, just to piggyback on what you were saying, I think all of us have been doing a lot of slats, spousal lifetime access trust, and I think a lot of us are obviously trying to make those non-reciprocal, but to get the maximum use, we're trying to do two separate non-reciprocal slats. I think it's really tempting to violate the Smaldino case. I think it's really tempting to business owners. Oh, let's just transfer some shares over to the husband or the wife, and then we'll do these slats. So I think that cooling off period, I mean, if you're doing this, it's tempting, especially when the House Ways and Means Committee, for example, in October, came out with these changes. And there was a big rush at the end of the year, if you remember, do this, and everybody wants to maximize. And so that temptation is really there, just to take some husband's assets over to the wife. She then contributes to a slat. They're really his assets. And when you do that so quickly that when there's no waiting period, was a step transaction. And that's what the Smaldino case said. And it's just so tempting in this day and age to make those quick transfers between spouses. And I think that's a real significant case.
And I think that sometimes in our, you know, we like to serve, we want to make clients happy. But sometimes, you know, like this particular client wasn't happy that we didn't let him go through with the movement of an LP interest based on a 409 valuation, and then he wanted to give minority interest. We said, it's not going to pass muster. So basically, you know, sometimes we have to be the bearer of bad news. We can, at the expense of trying to please the client, jeopardize their situation, or even as professionals, you know, put ourselves at risk. So sometimes we have to be the bearer of bad news.
Well, I know there are some questions. We have left room at the end for questions and answers. But let's go ahead and move on to really an important part of this presentation, and that's Jim Davis is going to be talking about retirement planning under the new regulations. So, Jim.
Thank you, Bill. No pressure there. Good afternoon, everyone. Nice to see everyone. I haven't seen everyone in person in quite some time. I think the last time we probably met was this in Zoom last year, was when we did a presentation on the Secure Act at that point in time. For clarification, you may recall I had a can of beer with a straw in it. There was a reason for that because much of what we take is from Natalie Choate. And so at Heckerling, she had a can of beer with a straw in it. Now, it's not realistic. I mean, who drinks a can of beer at 11 o'clock in the morning with a straw? So, but now having said that, with the obscure, secure regulations, it may not be bad to do your planning with a can of beer and a straw. So getting into the regulations, we've got 30 minutes. There's only so much we can cover within that period of time. But I kind of like to kind of cut to the chase and then get back into the basics of some of the regulations. First and foremost, I think that the designation should be kept simple as possible, because these regulations are extremely complicated and it's very easy to screw things up. There are things that aren't really answered in the proposed regulations. They're not effective, but you can rely upon them. I think outright to a beneficiary is the easiest and simplest, safest thing to do. Do not entrust if you can avoid it. If you have to use a trust, use a conduit trust. And we'll talk about that in a moment. It's easier and it's safer. Third, charitable beneficiaries, Community Foundation, perfect beneficiary for an IRA. 100% tax-free, income tax-free, estate tax-free, dollar for dollar. It is the best thing that can happen. Lastly, we're still looking at it, but it may be possible to take a large IRA and convert it into capital gains for the beneficiary with an immediate income distribution to the charity, get out from under the 10-year rule that we'll talk about, and possibly even use the balance of that in a GST trust. It seems kind of strange, but I think it's definitely possible. Stay tuned. The proposed regulations were issued on February 22nd of this year. There's not been that much commentary. Everybody's still digesting what they really are. I mentioned they're not really effective yet, but you can rely upon them. The major changes, we've gone over some of them in past years. The major changes are, one, the required beginning date is now 72 for decedents who die after 1/1/20. And technically it's April 1st of the calendar year in which they attain age 72, but then you need to take distributions in that year. The second is the 10-year rule, the new 10-year rule. Everyone has misinterpreted the 10-year rule. There's a lot more to it than we initially thought. We initially thought it was just like the 5-year rule and nothing more, but it turns out that it's quite a bit different. What factors into this is whether the date of death is before the required beginning date or after the required beginning date. If date of death is before the required beginning date for a normal designated beneficiary, and we'll talk about who that is and who's not, then no distributions are required until the end of the 10th year. Natalie Choate refers to that as the outer limits. When I grew up, that was a TV show. Really liked it too, by the way. But as a whole new meaning now. The other rule is that if date of death is beyond the required beginning date, then in addition to the 10-year rule for normal designated beneficiaries, there is the annual distribution requirement, which is the life expectancy rule. And that's based either on the participant and or the participant's lifetime or the beneficiary's lifetime. What happens is if those rules apply, then you've got the annual distribution requirement each year through years 1 through 9, based upon either the participant's life expectancy or the decedent's life expectancy. And then in the end of the 10th year, it's the anniversary of the 10th anniversary of the year of death of the decedent, everything must come out. So there's a 10-year maximum distribution period for all beneficiaries other than eligible designated beneficiaries that we'll talk about. Interestingly, in the proposed regulations, within this 10-year rule, if distributions occur within the 10-year rule that are not required distributions, not this annual required distribution, those are actually rolloverable in most cases. The 10th year is not, and the reason is required minimum distributions are not rolloverable. Distributions that are not lifetime annuity amounts can be rolled over. So if you do have someone who is a non-spouse designated beneficiary, that may be possible, it may be desirable. The proposed regulations, as I mentioned, were supposed to be effective for individuals who die after 1/1/20. Well, if there is a required distribution amount that was due in 2021, what do you do? Because most people said, we don't need to make distribution for 10 years. The answer would be filing form 5329, ask for forgiveness and take the distribution out with imputed earnings as soon as you can this year. And likelihood is you probably won't have any issues with that. Eligible designated beneficiaries. We all kind of knew what they were in general. The proposed regulations have drilled down and fine-tuned who those are. Spouse, pretty straightforward, must be married as of the date of death of the participant. A minor is a child who has not yet attained age 21. They become an adult in the calendar year in which they attain age 21. Doesn't make any difference which state law is. And that becomes important because they change from an EDB to a DB in that year in which they attain 21. Disabled, you have to really kind of read the regulation to determine the definition of disability. The person must be disabled as of the date of the participant's death. What happens after the date of death doesn't make any difference. If the beneficiary is under age 18, there is a much less standard for what is disabled. If they're over 18, basically it's like the Social Security definition. You really can't do much of anything. Evidence of disability must be given by September 30th, the year following date of death. The beneficiary determination, the beneficiary finalization date, or as they refer to it as the BFD, which is kind of ominous in terms of an abbreviation, but that's what it is. So you have to provide evidence of disability to the administrator no later than September 30th, the year following the date of death. Chronically ill, that tends more to be like someone who cannot perform life functions, more of a personal life issue than it is a working or mental issue. They're basically life functions. That also must be in existence as of the date of death, and the evidence of that must be certified by a physician and provided to the administrator by September 30th. Next, we have the not more than 10 years younger. And I must brag on this one. I've looked for that no more than sign in Word, and for a long time, and I've never been able to find that sign. For those of you who really want to find it, it's under symbols, mathematical operations, Cambria. That was difficult. The important thing there is that the no more than 10 years estate is based upon the actual dates of birth, not calendar years. So you're comparing actual birth dates. So those are the DBs. Who is a DB? Designated beneficiary, ordinary beneficiary. That person would generally be subject to the 10-year rule. The EDBs, as we'll see, have the ability to use some lifetime distributions. So DBs generally are individuals, period. Non-DBs are anyone other than individuals, estates, charities, even trusts. Trust technically is not a DB. Some trust can be, but a trust on its face is not a real DB. The beneficiary designation date, that the finalization date, the BFD, is the date as of which the DBs are determined. So in other words, if you have someone who's not a DB prior to that date, and there is a qualified disclaimer that is filed under 2518, they die before the BFD, they're not included. So if you have someone who may not qualify as an EDB, you might be able to make distribution out by that date or have them disclaimed. So Required minimum distributions. This is tough. It gets tougher when you get into trust, but the way I look at required minimum distributions is two ways. Number one, individuals. Number two, trusts, and keep them separate. They're totally different. For each of those categories, individuals and trusts, the first question you're going to want to ask is, what was the date of death? Was it before the required beginning date, or is it after the beginning date? Because that depends, that is very important to determine what the applicable distribution requirement is for each of those years. So we go through these each individual. A DB, before the required beginning date, we have a designated beneficiary. 10-year rule applies. No ADRs are required. Full distribution must be made by the end of the 10th year, but nothing's required before that. If there's no DB and before the required beginning date, the 10-year rule is a 5-year rule. So you must make distribution by the end of the 5th year. Again, no ADRs, no annual distribution requirements. Now let's talk about EDBs and minor children. Minor children, if there's a minor child, and again, we're talking outright, technically, we'll get into trust in a moment. We have time. The minor children, the minor children's life expectancy can be used for the ADRs up until age 21. At age 21, then the 10-year rule cuts in, and the distributions must continue to be made over years 1 through 9 using the ADR concept, annual distribution. And then finally, everything must come out at the end of 10 years, which is age 31. One thing to note, whether you designate a minor child outright or in trust using a conduit trust, minor trust is going to be taxed at, minor child is going to be taxed at trust rates until age 21. If they're in school, goes to age 24. Only earned income is subject to separate income tax. Otherwise, the kitty tax is going to really hit that minor child right away, whether it's an outright or whether it is in trust. Next is the spouse. The spouse options outright, individual, before the required beginning date, but the same as they always have been. There's 3. One is a spouse who can take the same benefits out of the IRA or plan, or they can wait until age 72, take them at that point in time, or the spouse can actually roll them over into his or her own rollover, not an inherited rollover, but his or her actual rollover. So those options were the same as they always were. Disabled and chronically ill. Those are 2 separate categories, but they're treated the same for the required minimum distributions prior to the required beginning date. Basically, it's over their individual life expectancies if they're being distributed outright individual as opposed to in trust. So that can be stretched out over their life expectancies. So effectively, the stretch trusts are available for those 2 categories. No more than 10 years younger, pretty much the same thing. Life expectancy of the not more than 10 years younger. The difference between the spouse and the other non-spouse beneficiaries for life expectancies is the spouse's life expectancy can be recomputed. And the spouse, it's recomputed up until age 120. So if you have someone who gets to 120, give me a call and we'll figure out what to do. For a non-spouse, they're not recalculated. I use a technical description called the 1- method. And that's just simply take their age, subtract 1 each year, and that's effectively the denominator, or what they call it, the applicable denominator now. Date of death after the required beginning date. Designated beneficiary. Designated beneficiary can take over the individual's ghost life expectancy. The ghost life expectancy, if you recall, is the remaining life expectancy of the individual who attained required beginning date, who's died prematurely. I like to refer to it as the zombie life expectancy, but it's this one and the same. So that can be taken over a longer period of time, or even the designated beneficiary's life expectancy. However, The 10-year rule still applies as the outer limit for a designated beneficiary. So again, you've got the annual distribution requirements, then you've got a 10-year outer limit for a normal designated beneficiary that takes after the RBD. If there is no designated beneficiary, this one doesn't make sense to me. The non-DB can take over the individual's gross life expectancy, not subject to the 10-year rule. Doesn't make sense, but that's the way the regs read. Minor children, the same type of concept, EDB, minors in EDB, life expectancy of the minor child up until age 21, and then the 10 years then cuts in. So pretty much the same as it was. Spouse, life expectancy, same options, 3 options as were in existence if death occurred prior to the RBD. Disabled, chronically ill, the life expectancy of the EDB is used for the ADR, the annual distributions, and then they continue. However, if the individual dies within that period of time, then the life expectancy method ceases and the 10-year rule cuts in. More than 10 years, not more than 10 years younger, the same applies as to the disabled chronically ill. So that brings us to this not too pleasant topic of trusts as beneficiaries. Every time I look at the regulations, I see something that I did not see before. So if something is to be corrected, my fault. General rule, as I said, is that trusts are not designated beneficiaries. So they're treated as non-DBs. In order to be a DB, there must be a see-through trust. It's a term of art. There are 4 requirements. You can look at them in the regulations. They make no sense, so disregard the 4 requirements. Assume it's a see-through trust. I say that not facetiously because every trust meets those 4 requirements. If there is a see-through trust, then there are 2 options for a see-through trust: a conduit trust or an accumulation trust. Conduit trust, just as a general rule, when you think about it, requires every distribution out of an IRA or plan to be distributed to the beneficiary, not just the ADRs, the annual distributions, anything. So if there are required distributions from the trust, from the IRA to the trust, and there's also ascertainable standards, so there's a distribution beyond the RMDs to the trust, that must come out immediately. Otherwise, it's not a conduit trust. So the advantage of a conduit trust is if you have secondary beneficiaries, once the primary beneficiary dies, they're not included for purposes of determining the RMDs, as we'll see, as is the case with accumulation trusts. So effectively, the conduit trust is treated very similarly as if the beneficiary was the outright beneficiary. The reason for the conduit trust, in my opinion, is to prevent the beneficiary from unilaterally accessing that IRA. That, in my opinion, is the primary purpose of it, control. If we get into the accumulation trust, and that's a trust that is any trust other than a conduit trust. And the accumulation trust is important because there's a 3-tier process to determine who the beneficiaries are for purposes of the annual distribution requirements. The first tier is the person who is entitled to current income distributions, or persons. There can be multiple. So anyone entitled to current distributions is a first-tier beneficiary. Second-tier beneficiary is what I would refer to under the probate code, trust code, as a qualified beneficiary, someone who will take after the death of the primary. If it's a charity, bad, because the first and second tiers are counted for purposes of who is the designated beneficiary and is there one. And because the charity won't qualify as an individual, trust won't qualify. So it will be a non-qualifying trust and subject to the 10-year rules. Or subject to the rules depending upon date of death. Third tier is who takes after the second tier, kind of a contingent beneficiary. They don't count. So if you have an accumulation trust The current beneficiaries and those who take after the current beneficiary's death are who counts. In the conduit trust, only the current beneficiaries count, and that's why it's so much easier to use that conduit trust. Now, there are a couple exceptions. I won't get into them too much, but there are exceptions if a minor is a beneficiary of accumulated trust, one of many beneficiaries, or more than one, I should say, and also disabled, chronically ill. There are special rules for those that give them preference so that there is a potential for a longer distribution period, but I wouldn't go there. It's just too complicated. If there is a mistake and there is a failure to make an RMD, there is of course a 50% excise tax. That's changed. Still 50%, but it's not paid by the trust, not the beneficiary. Used to be the beneficiary would pay everything with the 5329, is now the trusts. What if there are multiple beneficiaries? Well, all beneficiaries in those first 2 tiers must be taken into consideration. The longest life expectancy of the designated beneficiaries must be used for the ADR during the 10-year period, and then at the end of the 10th year, everything must be distributed. Exception to that is where all the beneficiaries are EDBs, first and second tiers. Then you can use the life expectancy, not subject to that 10-year outer limit. Very important, but very complicated. Otherwise, you use the oldest beneficiary's life expectancy and the 10-year period. Close up here as quickly as I can. Now, there's some exceptions to those rules. I would say that the main exceptions are what are referred to as the applicable multi-beneficiary trusts. And those are trusts where there are multiple beneficiaries, they're accumulation trusts, and they involve disabled, chronically ill. Those are really special trusts. There are 2 types of AMBTs, type 1, type 2, look right there. But the difference is that in type 1, there are separate trusts created for each beneficiary at the date of death. With the type 2, now there's an accumulation trust, and there could be multiple designated beneficiaries, but if there is an EDB who is disabled, chronically ill, and if the trust provides that nobody else gets any benefits until the disabled, chronically ill dies, then it still qualifies as a long-term trust, and the life expectancies of the EDB are used, even though there are other designated beneficiaries. They just can't get anything until the EDB. Why is that important? Special needs trust. Type 2 is what you would use for a special needs trust beneficiary. Couple of minutes in closing, just a couple comments. If you have multiple beneficiaries, whether they're individuals or multiple trusts, there are new separate accounts rule. This is very important for drafting purposes. If your IRA designation, beneficiary designation is your irrevocable trust, then the oldest beneficiary's age must be used under current rules. There's some thought that if there is a separation of the accounts by December 31st of the year following date of death, then the individuals can have separate inherited IRAs and their life expectancies are computed separately. Not really what the current regulations say. The proposed regulations make it very clear that that can occur. That is, you can clear everything out by December 31st and use those expectancies. You don't have to do that for accumulation trust for disabled, chronically ill. That can be paid directly to designated. The revocable trust can be designated as the beneficiary and still will qualify. But as a general rule, I would recommend in drafting, if you've got multiple beneficiaries who will receive an IRA benefits, and there will be in trust, not individual, designate the subtrusts themselves as the primary beneficiaries, or as the primary recipients for those beneficiaries, not the parent trust, but the subtrust. Very important. Otherwise, the separate share rule may not apply, and that may mean that you've got to use the age of the oldest designated beneficiary. One last thing, powers of appointment, I think I've done with time. Powers of appointment, if there's a power of appointment in a trust, the appointees are not taken into consideration until and unless they were actually appointed through exercise of the power. That occurs before September 30, the VFD date, then they're taken into consideration for that date. If there are takers in default, as most trusts will provide, then the takers in default will be the second tier beneficiaries. So you have to be real careful with that. If you've got a spouse as a primary beneficiary for life, and then a adult child as a contingent beneficiary, you're gonna have a 10-year trust. So you have to be very careful with trusts. I would strongly recommend you use conduit trusts. Keep everything very simple. Otherwise, it's going to get very, very difficult. In a nutshell, that's kind of a 20,000-foot picture of the regs.
All right, so now we're gonna have a test. I'm gonna ask each one of you a question on this now. Thank you, Jim. You know what I find is in this arena, I have to read this stuff every time I look at it. There's no way you can remember all these rules. They are so complex. And I recommend Natalie Choate's different books that she puts out, materials. If you Google Natalie Choate, I think she's got great materials. Do you have any other sources of reading? Because again, there's no way we can remember all this stuff.
Dr. Kugel.
Google?
Yes, Google.
Google.
Long story for that, but that's what we refer to it in the office from an incident that I had. But there is so much stuff that you can find on Google on these. There are outlines, there are articles. I mean, very, very professionally written articles, and I really would commend you to take a look at those. And the Lineberg letter has a lot of outlines and summaries. Gassman is another one, but they're all over the place, and you can find most of them on the web through Dr. Kugel.
There's Google Scholar too. That would be another one that I would look at.
That's over my head.
All right, well, Jim, thanks so much. Very difficult topic and lots of new surprising materials in these in this reg. All right, so next, Adam's going to talk a little bit about community property and also trust modifications.
Hope you heard Bill right. We're going to talk about community property. I've been a lawyer in Florida for 26 years. For most of the quarter century, even though going to Heckerling most years, I usually ignored community property. But here in Florida, we can no longer ignore community property rules. For those of you who don't remember, because we're all Floridians here, community property means that all property acquired by a husband and wife or between spouses during a marriage will be presumed to be owned as an undividable 1/2 interest for each spouse. This is important for California, let's do it all. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin, and Puerto Rico. Those are our community property states. However, why is this so important now? Let me ask a question. I didn't bring a prize, I should have. Certain parts of California, what can you expect to pay in state and city income tax? How about Oregon? Anybody want to venture a guess? In Oregon, it's about 10%, but in California, it's over 13%, especially if you live in Northern California. I've been talking to some of my colleagues, the people at this very table, and they're telling me we're seeing people from California move to Florida, and they're saving 13 cents on every dollar the minute they move to Florida and become a Florida resident. On top of that, they're bringing the advantages of community property. And as an attorney or a financial planner or a CPA, I think you need to be aware of those rules. But on top of all that, on July 1st of 2021, we were introduced to a new rule in Florida called the Florida Community Trusts Act. It's Florida Statute 736-1501 to 1512. There is something very similar in Tennessee and Kentucky. Alaska has one also, and so does South Dakota. Minnesota tried 4 times and it's failed. What is it? If you have a couple, husband, wife, wife, with substantial assets with low basis, that potentially would be subject to significant step up in basis advantage at the time of one death, why not try and go be greedy and get the whole step up in basis? I've not talked to too many attorneys yet that have drafted these. I have not found any clients willing to let me do this for them yet, but we'll work on it. So what is the point? The point is it's a new assets that are placed into this trust would continue to be treated as community property. And therefore, when the first spouse dies pursuant to the rules in the other community property jurisdictions, the whole asset gets a step up in basis. So if I bought a property for investment in Golden Beach for $100,000 30 years ago, and now it's worth $30 million, we could get a step up in basis upon my death, and my wife would see the benefit of that. This is a new planning tool. It is certainly interesting to note. I will tell you that it is untested for income tax purposes. It is untested for creditor purposes in Florida, just like any other rule is. Tennessee's had it since 2010, but again, couldn't find any significant case law using it yet. Kentucky's had it since 2020, too early to see any appellate case law yet. The IRS has been silent. What do I mean by that is they've let it go so far to date. Now that we've got a big state with a lot of people that might start using this, we'll see how what the IRS thinks about this. It'll be very interesting to note. A couple of other things. There are some disadvantages to this. Remember that if you have one spouse that has all the assets, and this was going to be great if they died, but if they had the other D and got divorced instead, they just gave half the asset to their spouse in the divorce. I don't think there's any family court judges in Dade, Broward, or Palm Beach that are going to feel differently on that. Remember also the income is assumed that any income produced from that property would be presumed to be half to each of them. And the third part, of course, is that, if it's somebody that moves around, what are the ramifications of having a Florida community trust if you're now living in a different jurisdiction? So just some interesting points. It's something relatively new, although we're sitting here in May, so I guess it's been around for 10 months now, but we do need to pay more attention to community property, both for our clients moving here from community property jurisdictions and because of this new planning opportunity. Remember, of course, that assets in Florida between spouses is always going to be considered tenants by the entirety, but this is a new option. If you have people moving here from a community property state, they are allowed to continue that community property nature. They just have to title the asset as community property, so they don't have to use the trust to do it. So just some interesting things. If you're interested to read a little bit more about it, it's IRS publication 555, which is a nice easy number, which will tell you all about it, although again, it doesn't say anything about the new Florida trust law in it. There are a few other states that are looking to do this, but nothing on the immediate horizon. With that, I'm actually going to catch up time a little bit. I'm going to let my partner here do her topic, and then Bill, if we have time at the end,
Okay.
I'll talk about trust modification.
And I'll try to be quick. So I really enjoyed Lauren's Wolverine section on ethics and error. I thought she hit on a couple of really great points that I always take something away from Heckerling just in the way I practice every day, but I loved her session. She talked about apologizing and whether, can attorneys apologize? And does it mean that they're admitting error? And what is the issue associated with liability? Insurance companies may not want you to apologize because it could mean that you're admitting error. However, she did say that it's something that we should do, that we should apologize, but just be careful how you're apologizing. If it's going to create an issue with an insurance claim, if there's potential litigation associated with the error. She talked about the ethic rules associated with disclosing mistakes to the client. Essentially, failure to communicate a mistake to a client, that may be a sanctionable mistake, a sanctionable offense, because you need to have an opportunity for the client to have informed consent. Is there an action that the client should be taking related to the mistake that you made? And she clarified, a typo in the document is not something you need to call the client and say, I misspelled your husband's name. That's not what she's talking about. That's not going to be a detriment to the client. But if a deadline was missed and now there are penalties and interest that's going to be assessed to the client, then that needs to be a mistake that you need to admit. We all need to admit to the client and see what course of action they would like to take. So just to clarify the difference. She talked a little bit about mistakes made in the way that trusts are drafted, either powers of appointment trust or Q-tip trust. So just being careful. As you know, power of appointment trust, the spouse should be the only beneficiary, and it should state that all income is to spouse. If you have any sort of language in there that limits who the spouse can appoint those assets to, now you've tainted it. You can't say, yeah, spouse can appoint to her, to herself or her estate only if, you know, she's doing A, B, and C. If you're limiting it, now you've actually got some stake. That will be an issue. That will not be a power of appointment trust. I thought this was really interesting only because we had a case in our office and the beneficiaries decided to sue the uncle because the term per stirpes, and we all look at the term per stirpes and think it's as clear as mud. But per stirpes apparently could mean very different things depending on the jurisdiction that's interpreting the per stirpes language. So basically she said everyone loves to use per stirpes. It kind of takes a whole paragraph of words that it would take us to just mean per stirpes. But per stirpes can have very different definitions. There's a strict per stirpes, and then there's a modern or modified per stirpes. So per stirpes, the strict definition is that it's split based on the descendants of the creator. And you would think that's pretty easy to know what that means. However, as I just indicated, if you're not defining what you meant by per stirpes in your document, you're gonna leave that open for interpretation because you can have a beneficiary in a different state than where the trust was drafted. Because in modern or modified per stirpes, if you have one person deceased in your first line of per stirpes, these other people could step up to the shoes of the deceased beneficiaries. So in the case of two children, you think per stirpes was 50-50. If you have one deceased child and they try to apply the modified per stirpes, they're actually going to do a third, a third, a third, which probably was not the grantor's initial intention. So the recommendation is that you be very specific, maybe just not use the word per stirpes, or just say one share to so-and-so, one share to so-and-so. This way you're not leaving it open to interpretation or confusion or worse, litigation. I thought this was a fascinating section because it's one of those things that maybe none of us may think about until all of a sudden we're like, yeah, how is that gonna work? She talked about the estate tax apportionment clauses, how maybe we can be a little bit more clear on which assets are going to be used to pay an estate tax. You know, if you think about your typical insurance trust, which is completely outside of your estate, or maybe a life insurance policy that's you know, there's a beneficiary designation to a life insurance policy. It's going to the beneficiary outright, but it was included in the estate, and now the estate has to pay an estate tax because of that policy. You know, how should the taxes be allocated? Are you going to call the beneficiary and say, yes, you know, you received $1 million, but the estate has to pay, you know, 20% estate tax, and you need to give us back 20%. So I think it should just be clear what trust, what assets are going to pay for an estate tax, especially if you have, you know, a GST protected trust. Do you want to touch a GST protected trust to pay an estate tax? Perhaps not. So maybe you can just be more thoughtful about what assets or what particular remaining trusts are going to pay for an estate tax due at the estate level. I thought, you know, again, that was great. And then the last thing that she mentioned, and I'll pass it back to Adam here, is she talked about the GST allocation, actually described it as a cruel and unusual punishment. And basically the caution here is that this is a very complex area. We all know that. And it's open to a lot of traps and a lot of opportunity to trick on GST. So, just think before we recommend. Careful not to step out of our areas of expertise. If you're not comfortable with GST, this is when you need to call a friend. But more importantly, I always love to end these sessions with the power of collaboration, right? Just having another professional in the room that you're bouncing ideas off and you're kind of thinking through, yeah, this is all the, I don't want to say jargon, but this is all the legal language. What does it mean? How does it affect the client? And just being able to think through all of the language that are in the estate plan. So with that said, I'm going to pass it back. I don't know if you want to go into trust.
Bill, it's 1:35. Tell me what you want.
I think at this point, I know there are some questions. I know Kurt had his hand up before. So let's go ahead and take some questions at this point.
Question was on small, what's your thought process on the period? The second, the gift needs to marinate before you make the second gift.
I've read a lot of materials on that. Some people say 3 months. 6 months is probably more, I would say maybe 3 months, at least 3 months, 6 months, probably better. Longer, the better, but those are the terms I've heard, 3 months, 6 months. Any of the panelists have?
Yeah,
different?
I 6 months sounds like a good time frame, but even better if we can go 6 months across 2 years, because then you have 1 year where maybe you're reporting step one, right? You create the FLP, it's funded, it kind of looks like it had a whole year to do its thing. And then year 2, now you're showing the gift. So I would love to see 6 months and then a 2 tax year span.
Well, I
Yes.
have a question for Jim. I was intrigued by those rolloverable amounts that are in excess of the minimum distribution. So if someone rolls them over to their own, I assume their own IRA, do they lose that 10-year requirement?
No,
Oh, they carry
we're talking about a non-spouse first and
Right.
foremost, because the spouse can do it freely. So you're talking about an inherited IRA. So all you're really doing is shifting the custodian or shifting out of a qualified plan into an IRA, that type of shift. So we call it a rollover, but it's more of a lateral pass.
Yeah, you're not really gaining much.
No. Not by way of extending the duration.
Right.
John?
Jim, sorry if I missed this, but are you using the terms conduit and see-through interchangeably?
No. The see-through trust has these 4 requirements that must be met. By the way, one of the 4 is that the trust document must be given to the administrator by the BFT. That's just one of the 4. The other ones are done. The conduit trust must be a see-through trust. An accumulation trust must be a see-through trust. A see-through trust is a trust where all of the beneficiaries are individuals. So you've got to start with the see-through trust so that all of the beneficiaries are individuals. Then you look to see whether it will be a conduit trust, which means immediate distributions, or this accumulation trust, which gets a little bit more complicated. So see-through is a general category, and then the 2 are subcategories.
If I could follow up, one other question. You didn't speak about it today, but any comments on the clawback rules or proposed rights that just came out as well? Anybody? I know it's just kind of brand new, but you guys are the best.
Still studying it. I saw it came out, but too new right now. You have any thoughts about it?
Questions already? Yeah, some of it's spelled out, some I obviously would keep words and cracks. Being a gift when it expires, not when it was made, so to speak. I'm getting questions now, issues around 2701. it's too complicated. I'm not even trying to understand the question that's being asked, where somebody broke a rule to cause it to be a gift, and whether or not that's gonna be deemed a gift later when the exemption is lower.
Right.
So there's already seminars scheduled, as I'm
Yeah.
sure people.
Yeah,
are
that'll be a
signing.
big topic for Heckerling next year, I'm sure. So
Yeah.
next year's panel, I'm sure we'll have lots of comments also.
Okay, one more last question. Any other? Yeah, Mona.
A question for Jim. So for a client who might have created separate accounts and make beneficiary designation to the sub-trust and did everything to maximize the stretch for the beneficiaries, and you're still living but incapacitated or just don't make changes to the trust, what is the effect now if the trust isn't, if they aren't able to modify?
Not sure I quite followed it, but this is after
So-
1/1.
Is there anything that you can do? What would be the result if a client didn't change now under the new Secure Act regs or rules and regs, and had originally drafted their documents to maximize the stretch in a trust, in an accumulation trust? Then what would be the effect if they haven't changed that?
So they're still alive. We're talking estate planning then.
Yeah, well, I mean, obviously, if they're still capacitated, we want to get them to change their documents. If they have a trust protector or some other way to change it, if they can't be modified. But what happens if they haven't done anything and they die?
Well, if we're talking about trust for the disabled or chronically ill,
No, just regular, it's in the way that they use.
well, here's just I don't know if that answers your question, but if they're individual, if the IRA has individual beneficiaries, the separate account rules will apply if they separate the accounts by December 31st of the year following. That is the new proposed reg. That will not apply to sub-trusts. So there are no separate accounts for sub-trusts with two exceptions. One is with the trust of a minor, and one is a trust with a disabled or chronically ill. Those two trusts can actually have multiple beneficiaries and still qualify for the long-term distributions.
Right, and if they don't qualify as one of the special categories, does the tenure rule apply?
Yes. Yes. Yeah, they lose that ability to stretch it out then.
Okay, so it's otherwise no harm, no foul, it'll just end up the way, it'll just.
The probate courts in the Tri-County area, if I could jump in, are also very open to making changes to it, even an irrevocable trust, especially with all the parties being alive in a situation like that. So I would feel very comfortable going to the probate, any of the probate judges, probably anywhere in the state, and being able to easily get a modification to such an irrevocable document.
If it's already come into play, I'm not sure that that's
Yeah,
possible.
I don't know.
It's the-
It wouldn't be for tax purposes, but I'm
Yes,
assuming
right.
if the person was still alive, even if they were incapacitated.
Right, so, yeah, I don't think you do that for tax purposes if the trust already exists, but, right, for distribution purposes. though.
All right, well, thank you very much, panelists.
Yeah, in closing, I would like to thank our panelists and our moderator for a thought-provoking panel discussion. I think we've all learned something today about this. And on behalf of the Community Foundation, we have some gifts for our panelists. I'm going to start with Adam here.
Thank you, Madam Chairman.
Thank you so much. And Jim,
Thank you.
and last but not least, Bill.
Thank you.
Some important housekeeping items before we leave. If you're attending in person, make sure that you've completed the attendance list, which I believe have been picked up at all tables. If not, just make sure that you've signed in. And I think that we're going to have a completion certificate on the way out. And don't forget to get your parking ticket stamped at the door. Actually, when I came in, there was no one there to give parking tickets. So I'm not sure what we're going to do here.
Latoya, what are we doing with parking? Don't need it.
Okay, and for those attending online, a completion certificate will be emailed to you. And just a reminder, everyone will be responsible for reporting your own credits to your respective agencies. And last but not least, don't forget to discuss philanthropy with your clients. And don't be afraid to lean on the Community Foundation as a resource and partner. Mark, Nancy, Mary, Margaret, and the rest of the staff are always available to assist us. And thank you for attending today and have a great rest of your day. Thank you.
You.